Hey everyone, and welcome. Today we are unpacking a seriously fascinating set of corporate data. Now, if you follow the regional banking sector at all, you already know it's a space that absolutely demands agility, really smart relationship management, and highly disciplined growth. Well, WesBanco just released their second quarter 2026 earnings report, and it offers some incredible insights into exactly how they are balancing all three of those things. In this explainer, we're going to break down how they pulled off their latest numbers, we're going to dig into the headwinds they faced, the strategies they used to beat them, and what these figures actually tell us about the foundational health of the bank. So let's jump right into our primary source material, WesBanco's official press release from July 21st, 2026. Right out of the gate, the company did not mince words. They highlighted strong annualized loan growth, a top-tier efficiency ratio, and accelerating growth in their targeted expansion markets. When a bank leads a quarterly report with those specific metrics, they're sending a very clear, very loud signal to the market, which is, we're growing and we're doing it profitably. And boom, here is the ultimate result of that strategy, $88.4 million. That is the net income available to common shareholders for the second quarter of 2026. Look, when we analyze corporate financials, this is the bottom line that everybody scrambles to find first, right? This number proves that the operational strategies we are about to dive into aren't just theoretical. They are literally translating into hard profitability for the shareholders. To make sense of this dense 14-page report, here is our roadmap for this explainer. First, financial highlights. Then, driving strong loan growth. Third, record profitability and efficiency. Fourth, expanding the banking franchise. And finally, credit quality and capital health. All right, kicking things off with pillar number 1, Q2 2026 financial highlights. We already know the total net income was $88.4 million, but let's break that down into earnings per share to really see the impact. The year-over-year contrast here is honestly pretty stark. Back in Q2 of 2025, WesBanco reported diluted earnings per share of 57 cents. Fast forward exactly 1 year to Q2 2026, and that number has surged to 91 cents. That tells you the bank isn't just bringing in more money overall, the actual value they are generating for every single individual share has drastically increased. Moving right along to Section 2, driving strong loan growth. Now, it wasn't all just smooth sailing. A major hurdle for WesBanco this quarter was dealing with elevated commercial real estate payoffs, which totaled roughly $345 million. Think about that. Just to keep their portfolio flat, they had to originate $345 million in brand new loans just to replace the ones rolling off the books. So the big question, did they replace it? Oh, absolutely. Despite having to backfill that massive $345 million hole, WesBanco still generated an 8.3% annualized sequential loan growth over the prior quarter. And on a year-over-year basis, their total portfolio loans increased by 3.5%. Their organic growth engine across their markets is just so robust, it didn't merely absorb that massive headwind, it completely pushed right past it. And they are definitely not hitting the brakes anytime soon. $2.3 billion. That is the sheer weight of their commercial loan pipeline as of June 30, 2026. For anyone needing a quick reminder, a pipeline represents future business, loans that are in the works but just haven't closed yet. According to the report, this pipeline has grown an astonishing 90% since year-end. This is a record level for WesBanco, and it reflects some seriously aggressive business development activity out in the field. To ground all this raw data in reality, we can look to the words of President and CEO Jeff Jackson. He noted that this performance reflects their relationship-focused banking model and disciplined growth strategy. Why this matters is because at the end of the day, banking is a people game. This quote anchors the success of that staggering $2.3 billion pipeline directly to their human strategy, which is building deep, meaningful relationships with commercial clients out in their communities. Okay, let's pivot to pillar number 3, record profitability and efficiency. Just a quick refresher for those of us who look at a million metrics a day, the efficiency ratio shows non-interest expenses as a percentage of revenue. So like golf, a lower percentage is actually much better. It essentially tells you exactly how much it costs the bank to generate $1 single of revenue. Well, WesBanco's efficiency ratio dropped to a record low of 51.2%. And what's really fascinating here is the trend. They managed to improve this ratio by more than 1 full percentage point, both year over year and quarter over quarter. This is the definition of fantastic positive operating leverage. It literally means their revenues are growing faster than their expenses, proving they're managing their discretionary spending incredibly well, even while they scale up the business. Another crucial metric driving all this profitability is the net interest margin, which came in at 3.63% for the second quarter. That's up 4 basis points year over year. The net interest margin is basically the spread between what a bank earns on the loans it gives out and what it pays out on deposits. The report highlights that this increase was primarily driven by lower funding costs and asset repricing. In short, they're actively managing their deposit costs while capturing higher yields on their loans. It's a win-win.
Up next, Section 4, Expanding the Banking Franchise.
To ensure they maintain this long-term momentum, they aren't just sitting still. They are actively targeting specific new geographies for expansion: Northern Virginia, Tennessee, and South Florida. The report notes they are heavily advancing their organic growth strategy in these exact regions. Even more specifically, they are laying the groundwork for their Florida franchise with planned financial center openings scheduled for the first half of 2027. They are literally putting the bricks and mortar in place to secure their future footprint. And that brings us to our final pillar today: credit quality and capital health. Crucially, non-performing loans remained totally flat compared to the first quarter. Now, with the aggressive loan growth we talked about earlier, you might be wondering, are they taking on too much bad risk? But their credit quality measures have actually stayed in a very consistent historical range. This is incredibly reassuring for shareholders. It proves that WesBanco isn't just lowering its underwriting standards to blindly chase that $2.3 billion pipeline. Finally, let's check under the hood at their overall capital health. As of June 30, 2026, their Tier 1 leverage was 9.83%, their Common Equity Tier 1 ratio was 10.70%, and their total risk-based capital was 14.18%. The big takeaway here is that all of these key ratios remain rock solid. They are keeping a very significant cushion, staying well above the well-capitalized standards set by federal bank regulators, giving them plenty of dry powder to fund those big growth ambitions. Which brings us to our conclusion. And the one big question I want to leave you pondering today. We've seen the absolutely incredible Q2 2026 numbers. We've seen the record low efficiency ratio. But when you look at that record $2.3 billion pipeline and you combine it with those strategic expansion centers opening in Florida and Virginia next year, can WesBanco maintain this top-tier momentum into 2027? Well, based on the data we've unpacked in this explainer, it certainly suggests they have the foundation, the strategy, and the discipline to pull it off. Thanks so much for joining me today, and I hope this deep dive helped bring these financial realities to life for you.